I'm Dr. Renee Friedman. I'm editor-in-chief here at Exante. And today I'll be giving a market overview of what's been happening in markets over the past few months and what we can look out for over the next few months, along with some of the risks and opportunities. To the, not certain what side, right or left of your screen, you'll see a number of images. These are just some of the content products that we produce. Hopefully all of you are receiving some, if not all of these. These are our daily market newsletter, our weekly newsletter, our monthly and quarterlies. We also produce a fixed income briefing, an equity monthly review. We also create further equity research through our Alpha Vibe series, which takes a deep dive, I should say, into a particular equity sector. We do produce standalone research white papers. And in addition, for our non-UK clients, we produce 2 crypto products. Our blog called The Crypt, which focuses on ETFs, ETPs, crypto related, and our weekly Proof of the Week, which is a roundup of everything happening in the cryptoverse. So to move quickly along, the main things we'll be discussing today is obviously the US, Europe, the UK, and we can also take a look at commodities, what's happening in commodities markets, global risks, and we can also touch upon emerging markets. So the big things discussing today within the US will be Fed moves in bond markets, the equities rally, how soft a landing we may or may not have, and of course, US geopolitics. Now, a lot of what we've seen over the past 6 months in terms of yields, it's been an interesting movement. Yield curves have been declining, then elevating, and declining again. Current 10-year is coming in at 4.22. It was much, much higher a few months ago. I'm trying to find it on my screen here, going out. This is over the past 6 months, which basically led to a lot of dollar strengthening. And the dollar is expected actually to continue to remain roughly where it is, if not strengthen further, because at this point in time, we are only expecting 1 rate cut. Now, remember, beginning of the year, markets were expecting 6 rate cuts from the Fed. And the market was betting against the Fed, and the rules are don't ever bet against the Fed coming through. However, this has been happening in bond markets. Equity markets have continued to rally this year, US equity markets. In fact, we've had consecutive highs all through June for the S&P 500. So they've been rallying since the beginning of the year, led by the explosion of investor interest in AI stocks. Particularly, we've had NVIDIA this week become the highest rated, ranked in terms of valuation, surpassed Apple and Microsoft. And over the past few months in particular, you've seen these 3 stocks kind of going back and forth. And a lot of this is really quite surprising in many ways that the market has done this well in such a high interest rate environment. It essentially seems that the equities markets have adjusted to this scenario. And I'm kind of saying, all right, we're happy with the idea that we are looking at, higher rates for longer. We'll live with it. And in fact, corporate earnings were actually quite good this year. This past quarter. The blended growth rate for the S&P 500 came in at 5.9%, its highest level since Q1 2022. It exceeded all forecasts, so it's going up, 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 primarily on that AI. Now, this is the issue that we have within US equity markets. We have a lot of concentration in particularly the 5 of those Magnificent 7 stocks: NVIDIA, Microsoft, Apple, Amazon to a certain extent, and Meta, really coming through quite strongly on that. And if anything happens to those stocks in terms of valuations, it will have a significant impact on the rest of the market moving forward. Right, I'm trying to get this to work and it will not go down. Okay. One moment here, sorry. Why is this not? Okay, here we go. Sorry, having some slight problems here. Now we've had the up, up, up of the market in equities, and I talked about the issues that we've had. Bond markets have underperformed quite significantly this year to date because we've had that uncertainty about what is actually happening with Fed movement. As a result, we've seen this issue around volatility. Now in the VIX, which is of course measuring equity market volatility, it's been dropping quite significantly. However, in the bond markets, we've seen that volatility rising and all over the place. And what that does cause a bit of a concern, because that rising volatility in the US bond market actually reflects in many ways the slowness of the Fed to move. It's causing that uncertainty. People are, at the beginning of the year expecting 6 rate cuts. Now it's down to 1 based on the latest projections by the Fed that came out, 12th of June. And there's this concern that the Fed may have to play catch up if economic growth, which we are starting to see slow down a little bit, if it starts to slow faster than is currently anticipated. Now that is a potential thing that would happen because we are seeing a slowdown in retail sales. We are seeing the retail consumer starting to be affected. Although unemployment is still very tight in the US, and I'll get to that more in a minute, it is slowly rising. It was at 4% from 3.9%. We are also seeing the pace of wage growth is starting to slow. It's still far too high for the Fed, hence the Fed not cutting rates. And we're not looking at a rate cut, as we said, until well after the summer. Probably move might happen after the election in November coming through. A lot of the Fed policymakers are taking let's sit back and see what the September data shows us coming through. So these are some definite risks that we are seeing in the market for some reason. Okay. And this is kind of points at the evolution of the Fed's fund rate. As I've already said, we've had a projected rate cuts at the start of the year. We're at 1 now, but many in the market are actually still trying to say we're going to have 2 cuts this year, that it's actually slowing. So yay, the Fed's going to jump on board. But there are some risks that we still have to be aware of, and I'll get to those risks further in a moment. And of course, one of the biggest risks that we have are US politics. Now, we're going to be looking at either Trump, who is going to most likely be elected as has the Republican nomination pretty much in hand. That will be confirmed in July. And the things that we're looking at, what happened if he wins, is tax cuts extended for the wealthy, higher levels of debt. Remember, we had high levels of debt because of that TCJA, which was the TCJA referring to the Tax Cut and Jobs Act that was put into place in 2017 under Trump. We're also looking at changes in the Inflation Reduction Act that was put in last year by Joe Biden, particularly the green side of that Inflation Reduction Act. Some of the other issues related to industrial policy, not as much. And I'm going to get into industrial policy later on. If Trump wins, we're also going to see potential impact in terms of immigration. Immigration's been very supportive for US economic growth this year. And of course, if we do see sudden cuts in immigration, that's going to have an impact on wages and of course, inflation. And again, at the end of the day, the expectation is that we're going to see larger budget deficits. Now, if Biden wins, he's most likely to repeal those tax cuts that run out this year, run out in 2025, I should say. And he's going to continue the student loan forgiveness. He'll continue with the IRA deal that he put through last year, that Inflation Reduction Act deal. The biggest issue that we're going to see coming through will really be the budget. Remember, we've had budget negotiations kicked that can down the line this year. Temporary measures on that budget ceiling. So that is an ongoing concern within the US because we have that issue of rising debt levels and payments. This is starting to, and goes on and off the radar, is starting to affect the perception of US dollar valuation, has been. It's one of the contributors to that. And in terms of Treasury yields, US Treasury is having to pay out its highest level of interest payments. It hit $1 trillion in March. And this is a concern. This will keep yields, and we also have a lot of debt issuance coming out from the US. So this is going to keep yields higher, even if we see rates coming down. Now, one of the other things you've mentioned, I've kind of put up on the side here, is wither the dollar, because there's been a lot of discussions, particularly at the most recent meeting of the BRICS and extended, including Saudi Arabia and others, that was held in South Africa earlier this year, of can we get out of the dollar? Should we move out of the petrodollar, et cetera? Fact of the matter is, although there's a World Gold Council survey that took place earlier this year. Results just came through. And developed market banks, large percentage, the majority, are now thinking that the dollar share of global reserves will fall over the next 5 years. And central banks are even more positive about this. However, there is no other reserve currency yet to replace the dollar. And that's due to the fact that the dollar is stable, it's liquid, and the level of returns are strong on it. So even though there's been lots of discussion about movements out of the dollar, it's still the global currency. Treasuries are still held, US treasuries are still held globally. So won't be moving out anytime soon. Right, I keep wanting to press the down button. This doesn't want to go ahead. Very quickly, we're at the time. European Union. Well, the EU has a lot of challenges ahead, and this is where we see the divergence. In the US, the Fed has not cut rates. It's not looking to cut rates. We're seeing that impact on currency. We're seeing that on equities markets. We're seeing this as well in terms of politics. So for the EU, we've seen that the ECB has cut rates by 25 basis points at its last meeting. It is, however, unlikely to move again until September. It's waiting for further data coming through because it has those concerns about its service sector wage growth coming through. We have to bear in mind that inflation did go up to 2.6% from 2.4%. We're looking at the next inflation number coming through in the next couple of weeks. Unemployment itself is still, I think at an all-time low, 6.4%. It was from 6.5% and 6.7% a year ago. So it's a very tight labor market still. Growth is starting to resume within the Eurozone, but not uniformly across the Eurozone. We're actually seeing the periphery countries performing better than the core countries of France and Germany. Fiscal issues, we have big deficits in France and Italy. They've both reached a 3% GDP limit. Not just those, but obviously Italy, Belgium, Malta, Slovakia, Hungary, and Poland have also breached those limits. France was at 5.5%, which was behind Italy's, which was a bit higher. The EU could potentially fine them, most likely won't. They're going to supposedly work with them, through the European Commission, to work with them on reducing their levels of debt. But this is going to be a big issue following on from those EU parliamentary elections that we are still seeing the fallout from. And of course, one of the biggest fallouts of that is the French elections, which I'll get to in a moment. However, European equity indices have been doing interesting things. The stocks has been done, obviously dropped quite significantly following the European elections, European parliamentary elections. There's a lot of concerns of, what does this mean for fiscal policy? What does this mean in terms of growth, et cetera? So there's an instant market reaction. However, in terms of when we look at European equities from a valuation standpoint, they may actually be attractive because their valuations are a lot lower relative to US valuations. And therefore, the share prices are expected to rise as those earning estimates are likely to be revised upwards because they are actually starting to grow a bit more. We're seeing that again in service sector, that tight labor market. The level of demand is there within Europe. And we see this divergence, as I said, in the valuations. You can see those over here. S&P are in the light blue over here. Stocks 600, which is the European market, is much, much lower. And of course, the valuations in Europe relative to US. So there is that opportunity for diversification. Europe does look cheap relative to US stocks. And most importantly, it has that better market breadth. When we see good performance in Europe, we are seeing it not just concentrated in 7 stocks, as we are seeing, or 5, which are taking up 36% of the market in the US of growth. We are seeing it more widely spread. Therefore, if there are any shocks, it's less likely to have a negative contagion effect the way it will in the US if those top stocks, particularly those AI-led stocks, experience any type of shock. I'll get this to, oops. Okay. This is also reflected in what we're seeing in terms of Treasury yields. The bond yields were hit by the parliamentary elections. We particularly saw the bond spread growing between Germany and France. And prior to this, we'd actually seen it shrinking between Italy, which everyone keeps an eye on, given their high debt levels at over 112%, relative to Germany, which is considered the most stablest economy. People trust German bonds. The fact that we have a mixed growth picture, we've had the euro down versus the US dollar, and sterling, of course, it's been down against. So this is where we stand in terms of yields starting to come down, of course, following the ECB decision to cut. However, it's been staying within a range because everyone's sitting and waiting, thinking the ECB cut because it said it would cut. It made that announcement well before June in terms of guidance, unofficial or official. However, they are now sitting and waiting, and as ECB chief economist Philip Lane said, they can afford to sit back and wait a bit longer. Now, the big thing I want to get into in terms of divergence as well, in terms of politics, and they're not the same of what happens in Europe. It's not the same what happens in the US when you have, one state affected. It doesn't affect the rest of the country as much. Within Europe, it does, because these are all independent countries with independent parliaments themselves. So when we look at the parliamentary elections, we see the issue that, that they're looking to strike a formal deal on the senior jobs, most likely next week. They're still in negotiations at this stage. There's a lot of misconception about what happened to the European parliamentary elections. Yes, in individual areas, it did move further to the right. However, when you look at the wider picture of what happened, it still very much stayed towards the center. And it's quite interesting in the sense of, we did a poll right after the elections, and we asked if people were more worried about the level of public debt and potential impact on the euro. And as we saw above, what was happening, what we've seen in terms of the currency, 32% were more worried, 27% were less worried, 25% weren't, not really impacted, but I said don't invest in anything within the Eurozone, and 16% didn't know. But the fact that 32% of investors are actually more worried about this does have repercussions. And there's repercussions in many ways. And we will see this from the equity markets, despite the equity markets having relatively low valuations relative to the US, because there are a number of particular factors. With the parliamentary elections comes the approval of the College of Commissioners, which means that you're going to see changes in policy priorities. European defense, European spending on defense, issues around enlargement, which of course have very wide fiscal implications. Remember, EU trans funds that go through, and of course, migration policies, which will affect wages and the ability of trade unions to maintain a grip on wage negotiations. We also have the issue of the budgeting process, which is due to start for the next EU budget starting in 2028 during this newly elected parliament. Will be part of their mandate. And we also, of course, have the impact in terms of regulations on technology, on trade. I'll get into some of the issues around industrial policy and trade, potential for trade war in a moment. All that will be affecting competition. It will be affecting equity markets as a result within Europe, and also in terms of its trading relationships and where it exports to other countries outside. And then we, of course, we look at the EU enlargement agenda. As I said, overall will be affected. Right, within the UK, we have the bank BoE decision today. I'm going to be moving quickly along, going very slowly. Kept rates at 5.25%. We had 3 people dissenting from that vote. What markets are pricing in just under 2 cuts for this year, likely to wait to August, more likely, potentially even later. The big issue, of course, is that inflation still remains elevated. July election coming through. We're expecting that labor market supermajority. The implications, of course, are for an increased tax burden and maybe not as quite friendly as a business environment. We can see this UK equity markets have been doing some interesting things. It actually did really, really well through May. It's been up, up, up. People tend to ignore that, the smaller markets coming through. However, what we've seen since is that UK small cap have been performing better than large cap. That's because, you look at the value of the share price. So that's really what the reason behind that. You come from lower value, you're going to do better. But the slower pace of rate cuts isn't affecting investor sentiment. Gilts, again, same thing on the yield curve. We're seeing Bank of England movement affecting the yield curve. Although it will move later than the ECB, it may move before the Fed, but that sticky service inflation is going to be an important factor. The other thing that will not move yields that considerably within the UK is the fact that we are looking at more borrowing. Much as we're looking at more borrowing in the US, we've had lots of debt auctions coming through, which has an impact on yields because levels of demand maybe not as high initially they were, now they dropped. In the UK, we are looking at £265 billion of government bonds in this financial year, way up from last year. Okay, what we're seeing, of course, when we talk about policy divergence, I talk about the Fed, they're holding. ECB's moved, now sitting. Bank of England hasn't moved yet, looking at some potentials because they have reached that 2% inflation target, but they are worried about that sticky wage growth. Is that we've seen this divergence in currencies. Sterling has been the best G10 performer against the US dollar this year, but we are looking at divergence likely to increase across the board, across from the pound, the euro, as well as the yen. And the yen I'll get to in a moment. We can discuss that further if anyone has any questions. Commodities wise, we're taking a look at oil. It's been fueled by growing optimism regarding the demand outlook. That's due to the OPEC and IEA reports coming through. Also by geopolitical risk. We have the Middle East wars. I put wars in plural because we may be looking at a second front opening between Hezbollah and Israel and Lebanon. And of course, the continuing Ukraine-Russia conflict. Supplies are not as much as a worry. US shale production is high, inventory strong. So essentially, OPEC has a hard time managing the price. The demand side is questionable as Chinese recovery is uneven. Despite a strong start to summer driving season in the US, things have been looking a bit downward. We're also looking at that slow rise in renewable energy potentially also having an impact. Gold has been supported again by that rising global risk premium and central bank purchases. It's been down recently. That's because People Bank of China has temporarily stopped purchases. But again, to that World Gold Council survey, 81% of respondents are expecting global central bank reserves to increase over the next 12 months. So essentially, gold is up, will stay up. It will stay range bound for a period of time. It did go over that 2,400 level. It has dropped below, but there's a good opportunity for it to potentially be going up further, again, because global risk premium will also stay very, very high. Cryptocurrencies, Bitcoin has been down. It's been down over the last 7 days, down over the last 3 months. It's still up over 50%, 51.5% in the last 6 months. Ethereum's back up. We have the SEC saying, yep, we're thinking it's a commodity. We're kind of happy with what you've put through. So we're looking at that Ethereum ETF potentially coming through. Remember the boost that was to Bitcoin, bringing it back in March up over the 73,000 mark. So we're looking at that actually coming back up again. Global cryptocurrency cap today is 2.52 trillion. It's a bit down. We have seen outflows this week. A lot of that is related to that hawkish FOMC meeting. Again, that Fed meeting that we saw. So we've had outflows of over 714 million between 13th and 18th June happening there. So the big things I want you to be thinking about as investors is to think about, of course, potential for trade wars. We've seen the EU announced additional tariffs. So we've seen that against the Chinese on EVs. We've had the US do that. There's also issues around steel and other commodities. And other things I'd like you to be thinking about, of course, is global risk, political risk rising. We know we have the ongoing wars in Ukraine, the expansion in the Middle East, most likely. We have new sanctions against Russia coming through. And of course, that affects the evolution of that Chinese-Russia power relationship. We're seeing that in how Putin is going and visiting North Korea, he's visiting Vietnam. Again, some of these, these are Chinese, basically, not proxy states, but highly influenced by what the Chinese government says. And of course, with the US-China relationship, as well as the EU-China relationship, not looking particularly steady. We have those increased exercises by China in the South China Seas, which has, of course, Taiwan incredibly concerned. The US has just allocated additional funding to Taiwan for military purchases, so that we're going to see a bit of a ramp up in terms of that risk rising. We also have the potential for clashing industrial policies. Remember, we have the US industrial policies coming through under the Inflation Reduction Act. We have them coming through more strongly coming through out of Europe. And again, that will change as we see that right wing bargaining with that center parties in the European Parliament looking to, in fact, tighten individual industrial policies as well as region-wide. That will, of course, have an impact on commodities, particularly within the renewables sector. We are looking at increasing geofragmentation in trading relationships as a result. And again, that comes through the reshoring, nearshoring, and changes in offshoring that we've had. We will have some beneficiaries, such as Mexico, and we will have those who do suffer as a result as well. And of course, the general geopolitical risk rise will most likely lead to some rebalancing in FX reserves. That will be a reflection of changes in trading relationships. And so that's it from me. I think there we are. And I just wanted to know if we had any questions from the audience coming through. There are no questions coming through. Well, that's quite a shocker. Okay. I do want to add one other thing, that when we are looking at what will be happening in terms of this increasing divergence and, everything's looking rosy in the US and reaching that potential soft landing, Europe looking like it might just squeak by, the UK is a bit of a mixed one. When we consider any potential shocks that could blow everything off course, the US is actually still in a good position because it is energy independent. It has more commodities and has a larger labor force. Within Europe, particularly within the UK, it's a small open economy, is that it is more likely to be affected by any sharp rises that we see through geopolitical risk of oil and other energy, food prices going up, and of course, the challenges caused by immigration. And amongst the other risks I didn't list, of course, that are always there are the fact that we are looking at demographic change globally. We have these immigration shifts, we have aging populations, and of course, we also have the concerns around climate change, which will be affecting companies and companies' balance sheets. So those are other things to think about when you are looking sector by sector in terms of your investing, as well as looking at sovereign risk, things associated with that. And the other thing I wanted to bring up before I close out is in terms of opportunities. I mentioned Europe relative to the US. Europe is a bit riskier in many ways, but the US risk is concentrated. The concentration risk is much higher than is in Europe due to the breadth of the European market. The other thing is in bond volatility. So the US has been much more volatile than European bonds, which in many ways, and when we compare that to emerging market bond markets, emerging markets started cut rates far before developed markets, and they're already well on that pathway. They have been impacted. They've also been building up their gold reserves as well to support their currencies. What this means in terms of that bond volatility is it actually gives an opportunity for diversification for investors to look across different sovereign bond markets to get yield, as well as looking at different levels of duration. So that would be a great thing. I guess there are no questions coming through. If there are any questions at any point, all of you who do get our newsletter, please feel free to reach out to me through that. We'll be having more webinars coming forward. We'll be having another one in July and then a break in August. And then, of course, September, we'll be looking at what's been happening in terms of central banks and further movements on that because of a lot more data coming through. And of course, we'll be having a pre-election US special coming through in October. So I guess that is it from me. And thank you very much for joining.